Should you invest in real estate? From lease up to move out and everything in between, owning rental properties can be a lot of work. However, one of the many benefits, aside from additional income, of owning rental property are the rental property tax deductions of owning these assets. So what are rental property tax deductions? Maintenance and repairs. This includes the cost of labor and materials. General items needed to keep the property in habitable and good working condition, like leaky faucets, broken windows or screens, lawn care, and pest control. They are deducted in full the year they were repaired. Major or capital improvements like a new roof or central heat and air, something that adds value to your property, is depreciated over 7.5 years. Utilities while the property is vacant and that are not paid for by your tenant when occupied, including water, trash, and sewer. A successful real estate investor doesn't work alone, but normally relies on the expertise of professionals to help keep the business running smoothly. So your professional and legal fees paid to realtors, property managers, attorneys, or tax accountants are also deductible. Independent contractors and employees who work directly for you. Advertising and marketing costs on your property. Commissions and referrals paid to a licensed realtor or finder fees to existing tenants in multifamily property for referring a tenant are also fully deductible. Personal property like appliances, landscaping, equipment, and tools. Interest payments including interest on the mortgage. Credit cards used to purchase items strictly for the property. And home equity lines of credit. And note, if your landlord earnings are more than $25 million from your rental properties, the IRS limits the amount of interest deductions, so you'll need to consult with a tax specialist for additional information on that. Insurance premiums you pay, such as liability, theft, fire, and flood, are fully deductible, and if you have employees and you withhold payroll tax, then you can also deduct the cost of health and workers' compensation insurance. Depreciation. The IRS depreciation on expenses allows you to deduct a 3.636% of your residential property value, excluding the land value, each year up to 27.5 years to recover the cost of wear and tear. This is a non-cash deduction that allows you to reduce your amount of taxable net income and possibly shift into a lower tax bracket, creating even less taxable income. Travel expense involving traveling to and from your rental property. The standard mileage deduction, vehicle expense, airfare, motel, meals can also be deducted from your rental income. And you need to be sure and document the purpose and keep accurate records proving the expense. Continuing education. Money spent to belong to a real estate investing club, subscriptions to real estate or business magazines, or tuition for education are also deductible. Travel must be mainly for business and have a clear business purpose. The dedicated space you have in your home for an office can also be deducted as rental property expense, and you'll need to check with the IRS guidelines for the method to follow when making your home office deductions. Pass-through tax deduction. This qualified business income was established by the Tax Cuts and Jobs Act of 2008, and this is an income tax deduction, not a rental property deduction. You're allowed to deduct up to 20% of your net rental income or 2.5% of the initial cost of your property, plus 25% of the amount you pay employees, depending on your level of personal income. For example, Bob owns a portfolio of single-family rentals in an LLC. If the net income generated is $50,000 per year, Bob may be able to use the pass-through deduction to write off $10,000 on his personal return. Consult with your tax advisor for this deduction. The costs involved when buying or selling a rental property are also tax deductible, and this would include closing costs, realtor fees, home warranties, attorney fees, state intangible taxes, appraisals, and any other closing costs. Capital gains and tax depreciation on recapture tax may be deferred when an investor conducts a 1031 tax deferred exchange. And with a 1031 exchange, instead of paying taxes on income from selling a rental property, an investor can put the money to work by investing in another rental property within 180 days of the sale. Use this information as a guide to discuss your allowable tax deductions with your tax professional. Find a tax professional that specializes in real estate and understands the finer points of depreciation, repairs versus capitalization, and passive activity to walk you through what you legally can deduct. Track your expenses carefully so as not to miss out on any opportunity for deductions. I'm Brenda Bianchi with Bianchi Realty and Property Management, and your home sold guaranteed realty.